All right, cool. Thanks everyone for hopping on. I'm sure a lot of people are gonna pop in as I start talking here. It's distracting, but I'll do my best to get past that. So this is session number 5. So thanks for hopping on. Today I'm gonna talk about a pretty powerful topic that really blew my mind when it came to commercial real estate and its creative financing. And what's so powerful about creative financing is it's more of an art than a science. It's just like how creative can you get. And what's nice about the terms is you can literally set the terms to whatever you want it to be. So that's what's crazy about seller financing or creative financing. So first, I just kind of want to start like what are the benefits of creative financing for the buyer. So what's nice for the buyer is all creative finance deals, it's typically less than 25% down. If you go through a traditional bank, you need 25% down at least. Maybe today you might need about 25 to 35% down. So of creative finance, you can most of my deals I've gotten 10 to 15% average down payment on creative financing. And what's also nice about creative financing is you don't need any credit, right? Like if you're starting off in single family and going to apartment complexes, a lot of lenders want you to have prior experience, but you're stuck in that catch 22. Like, how do I get experience if no one wants to lend me an apartment complex? So if you can do creative financing, you can basically get a deal and bypass the bank. So that's what's kind of nice as well. And then another thing too is, like I said, you can structure the deal however you like. And with creative financing, you can do a win-win situation. So I'll kind of get into some examples later. But that's just kind of the benefits for the buyer. In terms of the seller, there's actually a lot of good benefits. So, when I get my off-market deals, half the battle is just building trust and rapport. To be honest, I'm a stranger. I sent you a letter, from California. I'm mailing letters to Oklahoma, and I'm just a random guy that sent a letter. So you basically have to build that trust and figure out what the pain points are. So this is where it's a little bit more like soft skills that you need, more so versus like hard technical skills. But a lot of times the owners, let's say the property, they tell you they own the property for 30 years, and right off the bat, if someone owned a property for 30 years, the loans are amortized over 25 to 30 years, so most likely the property's paid off and it's owned free and clear, right? So if it's owned free and clear, you go to sell it, there's no loan. The owner's gonna pay large capital gains tax, most likely long-term capital gains tax, which ranges from 0 to 20%. So if you're selling an apartment for 2 million and it's a 20% tax bracket, like you can do the math. That's how much tax they'll pay. So right there, that's one seller motivation right there, right? Like, do they want a large tax bill? And then number two is in that same situation, these owners are used to getting cash flow every month. Like they literally own this apartment complex for 30 years. They've been getting cash flow every month. And it's hard to lose that, right? But if you seller finance the deal, the seller becomes the bank. And then essentially the bank gets paid on a monthly basis. So that's where you can negotiate with the seller, if they're open to doing seller financing. And another strategy too is, maybe the property is poorly managed. There's a lot of situations where I send a letter out, and the three most common situations I call it 3Ds. It's death, divorce, and disability. So I work in healthcare, so I see this stuff every day, like literally every day in the emergency department. Um, so let's just say, maybe the owner got hit by a car. He's self-managing the property. You know, no one else in the family wants to take care of it. They're too stressed out trying to deal with this disability. You might be crippled or handicapped now, and the property goes to the wayside, right? Like no one's managing the tenants anymore. They're not paying, increase in vacancy. They're not doing any repairs. Tenants don't pay. And that type of deal I just described, no lender would touch that with a 10-foot stick. So in that situation, their only choice is to do creative financing, unless you do a hard money loan. You can do a hard money loan, but you're going to be paying, 3 to 5 points up front, and 10 to 14% interest only. So, but your other alternative is to do kind of creative finance, where you can kind of create a win-win situation. So that's also very common, right? Like people when they're dealing with those 3Ds, they don't want to like worry about the real estate anymore. They just want to move on and kind of focus on the situation at hand. And if you do seller financing, you can close in 7 days. I mean, to be honest, like if I did a fully seller finance deal, I only need 7 days, and I only need 7 days because I just need to do a full property inspection. And depending on how many units it is, if it's 26 units, I can do it in 1 day. If it's 100 units, I probably need close to a week to inspect all 100 units. And then from there, I'll know if I want to take the deal or not. So that's another kind of powerful thing with creative financing is, you can kind of help people solve problems. And, I kind of emphasize in real estate, especially apartment complexes, you're not buying real estate, you're buying situations. And people have different situations at multiple segments of their life, right? Like right now they can be okay, but maybe in a year there might have been a death, divorce, disability that happened. So that's why if you consistently do a direct mailing campaign, like if your letter arrives at the right time and you can solve that situation, then you'll get that deal. So that's why it just takes consistency. And that's the only difference between me closing versus someone else, because these apartment owners are getting cold called, cold text, people knocking their doors, they're sending letters. But what makes you stand out is if you can solve the problem for them and explain how to solve that problem for them. Because essentially you're a stranger. So if you can hone that soft skill, you can literally buy so much real estate, creative financed, and it makes it a lot easier. And kind of another form of creative financing. So I'll go into specifics later. I'm just kind of talking at a high global level right now. But there's might be a situation where, the apartment complex, it's valued based on the NOI divided by the market cap rate. So if you increase the NOI, it increases the value of the property. That's good. But if you don't manage a property correctly and the NOI goes down, the property value goes down. So let's just say I bought it for $1 million. The NOI was, let's just make it 10,000, but I became disabled and now my NOI is 5,000. It's worth half now. It's worth half a million now. And if I sold that, I'd take a loss because my loan's probably 750,000. So if seller financing, or specifically subject to or master lease agreements, they could sell it to me. I just can take over the operations. I can take over all the management, all the day-to-day operations. They shift the deed over to my name. I'll pay them a monthly payment. The owner's name is still on the loan. They'll still continue to service the loan as usual. And there you go. You just solve the problem, right? So that's what's beautiful about creative financing. And why I want to talk about creative financing, because a lot of people, they ask me, like, Steven, how much money do I need to start? And if you go traditional financing, you need $300,000 to start. Like that's where, and that's buying like less than $1 million apartment complex in Oklahoma. And a lot of people do not have $300,000, and a lot, that's why people have to syndicate, right? Like they syndicate or they partner because they don't have that money. But on the flip side, who's going to trust you if you've never done a deal before? Are you just going to give me deals? I actually love Oklahoma. I own 2 apartment complexes in Oklahoma, and I want to buy more. So I actually love the market. Um, but in any case, it's so let me go into some specifics. This is a lot of information. It's going to blow your mind. This definitely blew my mind once I learned this concept. So let's get into the specifics. So, okay, the first one is seller carry first. So what does seller carry first mean? That means that the property is owned free and clear. There's no debt on the loan. It's owned free and clear. And a lot of my letters, to be honest, they hit a lot of these owners that own the property free and clear. And basically, seller carry first means that the owner will seller finance in first lien position. So first lien position is what the lender is. So if you buy a single family home or an apartment complex and you get a loan, the lender's in the first lien position. So if you go bankrupt, the lender they get first priority. They take over the property, they'll sell it, they'll take back their money, right? That's first lien position. That only applies if it's owned free and clear. That's it. So basically, they become the bank. So it's a pretty simple concept, right? So half the battle, and I mean, this is a golden nugget. That's if you apply this strategy, you'll literally make hundreds of thousands of dollars. And I'm just gonna throw it out there. But basically, if you can sell that, and how I sell it is you tell them you're becoming the bank, right? Like you move the totem pole. As an investor, I put down 25%, I ask 75% from the bank. But the next level is you become the bank, right? Like you're now getting paid on a monthly basis. You're not doing anything. right? If the operator that takes over the property messes up, you just take back over the property. You get to keep all the renovation expense that they did. You get to keep their down payment, all the interest payments you were made, and you just take over the property again. It's not like you're a beginner, right? You've managed a property for 30 years, so you can become the bank and have first lien position. So that's what's kind of nice. So, but sometimes the owner might say, hey, I want to transfer this money over to my business. Well, in that case, you can maybe have the seller carry second. So seller carry second means that they're in the second lien position. And what that means is it just helps you with your down payment. So as an example, if you need 25% down from the traditional lender, the seller can carry maybe 10 to 15% down. So that means that you only have to come out of pocket with 10 to 15% down. So now you're leveraged, right? You only have to down 10 to 15% versus 25 to 30. And what happens is the owner's in second lien position. So if you file bankruptcy, the lender gets whatever they need first, and the second lien position gets all the leftovers. So sometimes they may not get back their initial investment, so it's riskier, right? So typically, if someone's in second lien position, you pay them a higher interest rate because it's more risk, right? So that's how you incentivize people with that. And so, and you can ask, well, hey, the bank's in the first lien position. Will they care if someone's in a second lien position? And surprisingly, they do care. For some reason, they do care. And the reason for that is because it's more risk, right? They want you to have skin in the game as the operator. But my mentality is it never hurts to ask, right? And it's how you talk to the lenders. So when you talk to lenders, and no broker or syndicator will tell you this, but when you talk to lenders, literally all they care about is the debt service coverage ratio, and that has to be greater than 1.25. So once you know that and can leverage that concept, it's negotiations at this point. So I'll give you an example. If I down 25% on a property, my debt service coverage ratio is 1.5. That means it's a good property, right? Like it's cash flowing and the lender's going to like it. So when I pitch seller carry second, I say, hey, the seller will carry 15% down. I'm paying him 8% interest. And despite that, my debt service coverage ratio is still above 1.25. Let's just say it's 1.3. Is it okay the seller carries second 15% in second lien position? If you phrase it that way, you're now speaking the lender lingo, right? So like you have to ask it in many different ways. If they don't understand that, you just keep on phrasing it like, how can this be done, right? And if you work with the big national banks like Chase or Wells Fargo, they're going to say no, right? Because they're so strict. They have to go through certain processes. But if you work with a local community bank, like let's say one that's local in Oklahoma, whatever, I have a couple that I work with. Those ones, they might play ball with you because they're more flexible. You can talk to the president and you just talk numbers, right? All they care about is debt service coverage ratio above 1.25. And you ask, like I literally had a mobile home park under contract in Oklahoma, Woodward, Oklahoma specifically, and that thing with 30% down, it cash flowed. The debt service coverage ratio was 1.7. And I immediately asked, hey, can the seller carry 15%? And they said yes. So unfortunately, the deal fell through, but it's just kind of that concept of asking, right? And it never hurts to ask, and leveraging that. So that's seller carry second. And sometimes, like I said, what's beautiful about seller carry second is it can be like 50%. It can be whatever they want, right? If the property's owned free and clear, but that's how I negotiate it. And sometimes, like I'll say, hey, you can get 80% of your money, just lend me 20%. Right? So there's many creative ways to do that. Or on even a side note, it's kind of a workaround the lender. I don't recommend this, but something I thought about is they can become a private money lender to your LLC, have no lien position on the property. They can use that money to basically, renovate the property as an example. So that's another example you can leverage with creative financing. So that's seller carry second. The next concept, it's a little bit confusing in my opinion still. It's subject to or master lease agreement. So basically, subject to is more common in single family. That's a single family terminology. Master lease agreement is just the commercial real estate terminology of that, but they're one and the same. Master lease agreement equals subject to. I just use master lease agreement because it sounds more sophisticated. Like, oh, I have a master lease agreement with you. And it's actually more common than you think. Like the Empire State Building in New York, that was purchased through a master lease agreement. So it's been around for hundreds of years. So it's nothing new, right? But where you make your money or how you execute it is how you explain it. And even I struggle, to be honest, to explain it. But basically, you just transfer to dumb it down. You just transfer the deed from the other owner's name to your name, and then you'll take over the day-to-day operations. You'll negotiate agreed upon price to buy it at, the monthly payment, and your down payment. And the owner, because subject to, you typically would do this if there's still a loan on the property. That's why you do it. There's still a loan. It's not owned free and clear. So if you do subject to, at that point, there's still a loan. So the owner has to continue making payments to their lender. But then you make a payment to the owner, and then they make the payment to the lender as usual. So usually you want to automate that with a servicing company, a third party servicing company, like an escrow company, for example. They'll basically, you pay the servicing company, they'll pay the owner, and the owner will pay the lender. And the biggest fear that people have is a due on sale clause. So it is valid, right? When you transfer ownership from, let's just say, John over to me via subject to or master lease agreement, it can trigger a due on sale clause. But from my experience and from what I heard, for people that do hundreds of deals, um, lenders don't care unless if you pay them, right? As long as you pay them, they don't really care like what happens with the property. They're not in the business of managing the property. But if you do work with the local community bank and they happen to audit it, sometimes it just takes a conversation with the lender, usually the president of the bank, to explain what you're doing. Because in a weird way, if you didn't do subject to or master lease agreement and the owner is in a bad situation, they're going to have to foreclose. The bank's going to foreclose on that owner, and the bank has to take over the management of the property. And the bank doesn't want to do that. So if you explain that, hey, like, owner's in a bad situation, I'm taking over, I'm making all the payments, and this is my value add plan to make sure this apartment runs smoothly. So, that's just another strategy you have to deal with. And as you go through those hurdles. So, those are kind of three strategies that I typically pitch. And kind of a fourth strategy that I like to do as well is seller repair credit. So what I really specialize in is, so when you buy an apartment complex and let's say you have 100 units, you have to pay to inspect all 100 units. Like, some people are cheap. A lot of syndicators are cheap. They won't inspect all 100 units. I'll be honest. They inspect, like, they'll do a sample. They'll maybe sample like 20 out of 100 because it's cheaper and faster, right? But for me, I personally recommend you should inspect all 100 units. If you have a 100-unit apartment complex, you pay to get 100 units inspected because you don't want any surprises. It just takes like 5 bad units to ruin your deal. So for me, I don't want big surprises. So I pay all 100 units to get inspected. And then when I have the inspector there, I have my property manager there. I can be there if I want to be. And then also I'll have my contractor there because I'm getting quotes. Everything has a price, right? Hey, this unit's burned down. They never disclosed that to me. Well, how much does it cost to fix a burned down unit? I'm doing one right now. It's $60,000 in Oklahoma. It's very expensive, and that's Oklahoma. I could probably buy a brand new house for $60,000 in Oklahoma. And you inspect all the units, and then you basically, at the end of the inspection, you send the owner the inspection report. You give them all the quotes, and you ask for amendment to the contract to get a seller repair credit. And what's nice is, let's just say my 26 unit asked for 120,000. He said no, property as is. And I just said, well, hey, there's all these safety hazards. Like, if I don't close on this property, you're gonna have to fix all these safety hazards for the tenants. So let's meet in the middle. Give me 60,000, and he agreed. So it cut my down payment from 120,000 to 60,000. I down 60,000. I basically got the property for 10% down, essentially. So that's the power, right? And another tactic too is, so for my 26 unit as an example, I bought it for $500,000. It appraised at $750,000. So now that I know that if you offer a tax assessed price and they accept it, that's always under appraisal value. So what I do to the seller, I said, hey, can you just bump up my price by $200,000? So I bought for $500,000. Now I raise it to $700,000. But you give me $200,000 at the close of escrow for seller repair credit. And if you do the math, 25% of $500,000 is $125K. I asked for $200K in seller repair credit. I'm getting $70,000 at the close of escrow. I made money to buy this piece of property. Like, once you know that concept, you get paid to own a 26 unit apartment complex. Like, I literally paid someone, I think $5,000 to join a mentorship just to learn that concept I just threw out there. there is no cap in terms of the seller repair credit. You just have to phrase it in a clean way. So the way I phrase it is seller repair credit of $60,000 for renovation expense, because you want to make it seem that it's for or for seller renovation, something like that. Because you want to make it known to the lender that you're using that money for renovation, and you should be saving it for renovation, right? It's not like, hey, I'm just gonna lower it, but that's just an example of a deal where, like, I wish I did it on my first deal because I didn't realize that my property would overappraise by 250,000. But I could have literally asked for 100,000 more, asked for another 100,000 of seller repair credit, and I'd be 0% down in the deal and make money. Like, where else could you get a deal for free and make money? You can't do that in single family homes. So once you understand that concept, it blew my mind. Like that, that's like the golden nugget I had for this whole episode. is literally that concept. If you can master that concept, like, commercial real estate's unlimited. It really blew my mind. Um, so for me, I always treat it as seller repair credit because that's how. Like, if you were to ask me, would you rather have 100,000 off the price or 100,000 in seller repair credit? I'll always get 100,000 seller repair credit because that reduces my down payment, and you're more leveraged, right? So, um, so that's just kind of the concept there. So yeah, I learned that in one of my mentorships, and that completely blew my mind. So I'm just hoping to share this here, and I'm uploading this on YouTube. I went pretty fast, oversimplified the concepts, but basically I just went over like 4 to 5 strategies on basically how to get no or low money down. And what's also beautiful about creative financing too is, like, a lot of these owners, like, they're so fixated on a price and it's overpriced. Like, a lot of these owners, let's just say they want $1 million. They're fixated on $1 million, but it's worth $750,000 based on your sales comps, your NOI divided by cap rate, and maybe tax assessed price. And a bank won't lend on it, right? Because it's like, hey, they're not going to overpay for a property. At that point, I just tell them, hey, like, I underwrote the deal. The lender will not lend on it. Like, do you want to do creative financing? Like, if that's the case, I'll pay you your price. I'll pay you whatever price you want, but you give me my terms. Your price, my terms. And what are my terms I'm going to negotiate? I want a low down payment. So what I typically do is 10%. My rule is 10-5-5. I also learned this in my mentorship as well. 10% down, 5-year term, 5% interest only. That's where you start, right? But depending on the situation, I try to ask for less. Like, give me 5% down. It's negotiable, right? You can ask for a 10-year term, 15-year term, 20-year term. Some owners, they want to get monthly payments for the rest of their life as well as to pass on to their kids. In that case, I negotiate 20, 30-year terms because the kids don't want anything to do with the real estate. They just want the monthly income. The trust fund babies, right? That's what they want. They don't want to do all that. They just want to get the monthly cash flow. So, once you kind of understand those concepts, like creative finance, you can do whatever you want. And I'll tell you another strategy that I do. This is like literally a pro tip that works every time. Let's just say the owner wants 20% down, right? Or 25% down or 30% down. I'll be like, sure, I'll give you 30% down. I'll give you 5% year one, another 5% year two, the next 5% year three. And if you're smart about it, your cash flow will build up enough that 5% is covered by your annual cash flow. So essentially, you're getting it 0% down yourself. So there's, like I said, there's so many ways to do creative financing. And, I just basically, spit out a masterclass in creative financing in about 25 minutes. So I'm going to open up to some questions now. I saw a lot of questions in the comments. I'll go through those first, and then I'll just do a live Q&A. So for lenders, if you do seller financing, seller carry second, you must be transparent with the lender. Like, if you do not disclose that to the lender and you get a second lien position, they will definitely do a due on sale clause on you. So you want to be fully transparent with them. Another strategy that I missed is called cross collateral loans. It's not as common in today's age, but basically you're using equity from another property that you own. So let's just say for me, I own a single family home with about $500,000 equity in California. I can take some of that equity to lower my down payment for a new apartment complex that I'm buying. So let's just say I need 25% down. I can take 10% equity from my single family home if the lender lets me, and they'll be in second lien position on my single family home because I have a lender there already, and it'll help me reduce my down payment. But if you default, they're going to take over your single family home, force you to sell it, take their money. So that's the risk you take, right? So that's why a lot of lenders do not want to do that. But for me, I can't get HELOCs on some of my investment properties. I can't cash out refinance because the rates are terrible. My interest rate's like 3%. No way it's going to be 3%. But that's another way to leverage your equity that you have to make it from debt equity over to live equity. So that's called the velocity equity, right? So, and then ultimately, when you do creative financing, you have to know what your end strategy is, right? So I'm buy and hold. So for me, I want long terms. I want cheap interest rates, right? I want that term to be 20, 30 years because I'm going to hold this for the rest of my life, right? And I want it gives me time to do my value add plan, and eventually I'll do a cash out refi, pay off the seller, and then own the property, pull out some cash, and kind of repeat. That's the BRRRR method on steroids, right? When you do the BRRRR with apartment complexes, I call it the BRRRR on steroids because you make so much more money and it's so much easier and faster. Well, a little more headache and stress, but once you execute it, you make so much money there. So let me go through the lenders. So there's no cap on the closing credit for the lender. I just be transparent that hey, I showed my lender my inspection report, and usually when you look at the inspection report, there's so many items that need to be fixed that you can easily justify, closing credit or seller repair credit, and they know and they want you to have that money, right? Because they know that it's going to go back to fixing the roof, electrical panel, HVAC, all those big ticket items, landscaping, paint, whatever, right? Like as long as you make it known that you're using it for renovation. In worst case, they might just hold it in an escrow account that you can only use it when it's approved for renovation. Like that's your worst case situation if they want to be difficult with you. So that's why I say it's all about negotiations, right? You can always create a win-win situation. You just have to think creatively and not think so linearly. Like for me, if you tell me a solution, a problem, I'll give you 20 solutions to that problem. And once you can think like that, you'll be very successful in commercial real estate and apartment complexes specifically. Um, so, any other questions? I don't see any questions in the comments. I'll open it up now. Any kind of questions about creative financing? Yeah. So for HELOC, so I have multiple HELOCs. I have one through First Republic Bank. It's an unsecured line of credit up to 100,000. I have a line of credit through Charles Schwab, so I have an investment portfolio. It's non taxable or it's after tax. So I have a line of credit on my stock portfolio, and if you do use your HELOC for down payment or renovations, like with single families, you'll burn about maybe 6 to 8 months. But with apartment complexes for value add, it takes about maybe 2 to 3 years, depending on how much renovation you're doing. So it does take a while to do that cash out refi and pay off your HELOC. But what I do is I take the cash flow to pay it off on a monthly basis. So what's beautiful, so what I hate about single family homes is like when you're doing a BRRRR, that thing is vacant for 8 months and you're not making any money, right? But when I'm burning my 26 units, I'm fixing up 6 units right now. 20 units are paying me. I'm getting $10,000 a month with 6 units vacant. That $10,000 a month will cover all my expenses, my loan, my HELOC fee if I use the HELOC, and maybe some of my renovation expense, to be honest, at this point. And once I start renovating those units, at that point, once I rent them out, I'll slowly move out the other tenants and then renovate those units and then raise the rents. And then once I raise the rents, so on my 26 unit, for example, I bought for 500,000. I got about $60,000 in closing credit. I'm spending about $200,000 to renovate it. And I think it's going to be worth $1.5 million when I'm done. So when I cash out refi this thing, I'm going to make like, I think 600,000 something tax free. And no day job will make you that much. No fix and flipper will make $600,000 tax free. Syndicators, well, if you sell a deal that's large enough and you get your 3%, acquisition fee, you might make $600,000. But you're making it from purchasing. So that's just kind of how you do the BRRRR strategy on steroids. And I don't know any single family burn investor that makes $600,000 off one deal, right? So even if they did like 3 deals, it's at best I feel like people make like 100,000, if even. That's 300,000. So that's what's nice about the economies of scale of multifamily. I'm basically getting money while I'm fixing up my my apartment. And what's kind of crazy too is like at the close, the escrow rents are prorated. So like when I closed on my 26 unit, I got $5,000 of rent prorated because I closed in the middle of the month, plus all the security deposit, and that lowers your down payment as well. So, it kind of blows your mind a little bit once you learn about commercial real estate. So debt service coverage ratio, I forgot the exact. I think it's NOI divided by the purchase price. So if you take your net operating income divide by the purchase price, you'll calculate your debt service coverage ratio, and that needs to be above 1.25, and that's their metric. Some lenders want 1.3, but typically it's 1.25 to 1.3. You just ask the lender up front, like what their underwriting criteria is, because the debt service coverage ratio is based on like what's your down payment, how many years is the loan amortized, and what's your interest rate, right? And a lot of the lenders, they will use more conservative. So let's say I get 30-year AM for apartments, they underwrite with 25-year AM, so my monthly payment's higher, right? So it's going to lower my DSCR, and they'll raise up your interest rate by usually a half a point to a point. So that's going to lower your DSCR. So just ask your loan officer how they underwrite it, so that you know exactly how they do it. So so yeah, basically, it's kind of, is there a typical, so for the 10-5-5 rule, it's 5% interest only. So there's no amortization schedule. So you just take your loan amount that you owe. So let's just say I owe $100,000 times 0.05 divided by 12. That's your monthly payment. So it's interest only. So you don't pay down the principal. It's just interest only payments. And I like it because it's just more simple, to be honest. And typically, if it's interest only, you cash flow better, right? So that's why my 10-10-5-5 rule is that. So um, so for lead gens, yeah. So just so everyone knows, I'm actually working on based on popular demand, a course, apartment complex course that's going to teach basically single family investors to go from A through Z to close on their first apartment complex with probably low or no money down in about 12 months if you follow the system. And I basically just went over my creative finance lecture. It's about 20 modules. I'm about halfway done, and I have around 80 videos already, and I'm only halfway done. So when I'm done, I think it's going to be roughly, double that. And just so you have a pipeline. But, obviously I'm giving a lot of the free value on these weekly calls. So I encourage everyone, you can pretty much learn the course on these calls. But if you buy the course, it's just more structured, it goes A through Z with that there. But in one of my courses, I talk about direct mail. That's how I do. And if you watch my older video, so if you subscribe to my YouTube channel, I upload all these onto YouTube. Um, my second video talks about my direct mail campaign. I go into more specifics, but overall, I do a direct mail campaign. And let me tell you why. I like mail because honestly, cold texting is actually technically illegal. If you cold text people, I forgot there's some type of law that prohibits you from doing that. Like people have to opt in order for you to cold text them. So technically, it's illegal. And number two, if it does go through, a lot of phones detect it as spam. Like on my phone, I get a bunch of spam emails, and it's usually from like people trying to cold text me to buy my apartment complexes. And cold call, same thing. Like I have an Android or iPhone, like it'll tell you spam or a telemarketer. Those automatically will just, I block those immediately, right? So people are very annoyed by, cold spam and cold text. Um, so I do direct mail because I'm trying to target a certain demographic. I'm trying to target the older mom and pop owners. So those people are my parents' age, right? Like upper 60s. They want to retire. They check the mail, and mail's a lost art. Like, like, when was the last time you mailed a card to like a friend or family member, right? Like everyone just texts or like Facebook messages or something like that now. So for me, I'm trying to target the mom and pop, and especially in the Southeast, Midwest, like Oklahoma, they appreciate those letters, right? That they'll actually like open up in the mail. So it depends on your market, right? Know your demographic. So for me, I want the mom and pop. Why do I want mom and pop owners? Because number one, the property's more likely to be paid off, so I can do seller carry first. Number two, they probably haven't raised the rents in like 3 to 5 years because they're self managing the property. So right there, if I buy it right, I can raise the rents to market rate, renovate the units, do the burr on steroids. Number three is if they're too cheap to pay a broker, then most likely they're willing to play ball, right? If I don't usually work with brokers because they sell me overpriced deals. I never had a broker bring me a good deal, to be honest, to this day. Don't get me wrong. If you're a broker on this call and you can bring me a good deal, I will give you a plaque. I will hand make you a plaque and hang it because I've never got one yet, and I've had brokers bring me hundreds of deals. Um, and then so yeah, so what I do is I do a direct mail campaign through PropStream. If you reach out to me, I can give you a link for a 7-day trial, and I outsource my letters through Yellow Letter Complete. If you also reach out to me, I can connect you with a rep that helped me set up my direct mailing campaign. But it's $1.50 per letter. If you do it yourself, it's about half the cost, but it takes you 8 hours to prepare 300 letters. So save yourself some carpal tunnel and save yourself some stress. I mean, if you honestly, if you can't afford $1.50 a letter, you shouldn't be investing in apartment complexes in the first place. That's my opinion. Um, but it's about $1.50. I send 300 letters a month. So typical response rate is about 3% in Oklahoma. So it's about 9 to 10 owners that will reach out to me via text, email, all that stuff. So in Oklahoma, I get about a 3% response rate. And out of those 10 owners that call me, maybe like one or two are serious. Like the rest, their expectations are just so like skewed that like the deal doesn't make sense at all unless they sell or finance. And even me, I'm like, hey, I'll give you your price. I'll overpay by like $500,000 over appraised value. I'll give you your price. You give me my terms. And if I'm overpaying by 500,000, you better believe I'm asking for zero down. I want zero down on the deal, and a long term and 5% interest only. Or if you want me to down you 10, I'll down you 10%, but I'm gonna spread that 10% over 3 years, maybe 4 years, whatever, right? 2.5% for over 4 years, whatever that looks like. So that's what I mean by negotiations, right? Once you get this mindset, it blows your mind. So basically, I send about 300 letters. I mean, honestly, 10% come back to you because they're invalid addresses from PropStream. That's just the nature of the business. So every time I get a letter back, I'm like, damn, that's $1.50. That's a McDonald's burger. Every time a letter gets sent back to me, but that's just the nature of the business, right? Like I said, between your letters, so I spend 500 a month on letters plus PropStream another 100. So $600 a month is your marketing budget minimal. Um, so that's kind of the process there. But for me, if you want to know my metrics, and what I preach in my course is it's going to be about 1,800 letters on average to closing your first deal. So for me, I sent out 1,800 letters over 6 months. I closed on 2 deals. So my ratio in Oklahoma was 900. For every 100 letters I sent, I closed on one. Right. But I think half of my skill is my negotiation. Right. Like if you guys haven't told, like I can negotiate very well, and I leverage that from my day job. Right. Like I'm a pharmacy director at a hospital. So every day is a negotiation, right? Negotiating with everybody. So it's a skill set that can be taught. And I do teach a lot of my strategies on how to negotiate on my course and a lot of my one-on-one coaching calls, if anyone's interested. A lot of it is just teaching mindset, to be honest. Like real estate is just mindset. And basically you can't be cheap, right? Like if you're not willing to pay $600 to market, you don't belong in commercial real estate. Like that's bottom line. Like you don't belong in real estate, period, if you are too cheap to do this. Like for me, I paid over $30,000 of education. I've probably consumed over $10,000 of podcast or 10,000 hours of podcasts, and I basically condensed all that into this quick like 40-minute call about creative financing. And I've scaled from zero to I have a 200 unit mobile home park plus 2 apartment complexes all in 1 year, right? So I actually learned by doing. A lot of these gurus, they don't do anything, right? They just sit there, try to sell you a course, and they don't do anything, right? Like for me, I got sick of that, so I was just like, well, I want to create a course. I want to make a course that's actually meaningful from someone who's actually doing something, right? Like that's how you really learn is by doing. So, in my course, I give out my letter template. I give out my strategies on how to negotiate, like, a lot of seller objections and how to deal with that. Um, so yeah. In terms of cold call, so yeah, I go over pretty step by step over my course, but basically the key of the first call is to build trust. At the end of the day, you're a stranger. That sent, like I'm a stranger. I'm a pharmacist from California that sent you a letter, right? So like you get to build trust, and I leverage the fact that I'm a hospital pharmacist to my advantage. So I call myself Doctor Nguyen when I talk to these people in the southeast because that's how you build trust, right? Like, hey, I'm a doctor. I make good income. I work at a hospital. I'm trustworthy, right? So you leverage your title. You're a nurse. You're a veteran. Whatever your title is, you leverage that, right? So it's building that trust. And I'll be honest, like someone can, like me and someone else can send the same exact letter, but I guarantee you that I can out negotiate that other person because it's just about creating that win-win situation. And once you can do that, you'll blast through your competition. So I think my rate might be a little skewed because of just the soft skills. But it just takes time and practice, right? Like everything takes practice. Like I just didn't have this overnight. I've been doing this for like 9 years in pharmacy and, four, 5 years in real estate, like pretty actively. So, it takes practice, but I'm hoping with my course, I expedite your learning, right? Your learning curve. Like you can learn from my 10,000 hours to expedite your journey, right? I wish I had someone to teach me all that, right? I wish I could had a course that walked me A through Z. Like I paid for mentorships that were like 20,000, and honestly, like what I'm creating is way better at a significantly cheaper cost. Because I just like to give value for free because to me I value the relationship because I feel like if I train somebody, I'm sure it'll come back to me down the road in some way, some form, whatever, right? Um, so how do you get the addresses and list people to send the postcards? So I use PropStream. So reach out to me. I have a link for a free 7-day trial of PropStream, but it's $100 a month. There's many other types. There's batch leads, prospect now, but I just had the most best experience of PropStream in terms of my market. And in my course, I do step by step on how to do your filters for PropStream and how to do your letter, export your data and merge it with your letter. So I do pretty step by step in my course for PropStream. So, but that's how I get my data. And what's nice about PropStream too is you can run sales comps, so you can see like what apartments were sold in the past, like whatever 1 to 3 years, what that price was, so you can kind of get a better idea of your market. So I personally like PropStream. That's what I used. Like once again, reach out if you have any questions in regards to that. Yeah, so Oklahoma. So it sounds overly simplistic. Like I think a lot of people that I'm meeting, they overcomplicate apartment complexes. It's actually pretty simple. I literally chose Oklahoma because I had a good property manager there. Because what I kind of preach in my course is if you have a bad deal of a good property manager, it's a good deal. If you have a good deal of a bad property manager, it's a bad deal. And unfortunately, 9 out of 10 property managers are terrible. And how you know if they're good or bad, unfortunately, is you have to work with them for like 3 to 6 months before you know they're bad, right? Like that's just the nature of the business, unfortunately. So typically, I go through referrals, but literally, I chose Oklahoma just because I had a good property manager. Because I knew that I had a really strong property manager. It's easy to scale around them. And then Oklahoma, not to be a dead horse, but it's low property taxes. It meets the 1% rule easily. So 1% rule is, let's say a unit is 50,000 per unit. I can rent that thing for about over 500. So that's about the 1% rule. So you're going to cash flow. And I think it's slightly less competition. I'll be honest. Oklahoma is a steady Eddie market. Just by me advertising it, I'm sure I'm creating a lot of competition for myself. Like a lot of people are probably going to start sending letters to the market I'm in, but that's fine. Like I said, I prefer collaboration over competition. Um, I already have systems in place in Oklahoma, so obviously I can scale from like I own 46 units. I mean, I can easily scale to 1,000 units, like right now, if I wanted to syndicate. So like honestly, I could do that right now. But my problem is that like I don't want to. What I hate about syndicators is they ask for money without proving themselves first, and like you guys may think I'm further than you, but I'm only like one step ahead of you guys. Like I just happened to close on 3 commercial deals in the past year. I haven't gone through a full cycle yet, so I don't personally feel comfortable asking for money until I've done a full cycle, right? But if I do a full cycle, basically, at that point, if I start to syndicate a deal, people are gonna throw money at me. It's like literally a no brainer at that point, right? So, um, yeah, so that's why it's just more of a personal limitation myself. I can easily scale. Um, Yeah. So great question in regards to the market. So I do that's like the number one question for some reason for people going to apartments. I do go over it in my course. Pretty detailed, but at a high level, I basically Oh, sorry. If you guys are not talking, can you please mute your mic there? So basically, I like this. So I call it the smile state. So if you get the map of California, you draw a smiley face on it. That's where I like to invest. That's a sun belt. And why I like to do that is I don't want to deal with snow. Like no offense to anyone living in cold places, but I don't want to deal with like bursted frozen pipes and shoveling snow. So you just draw a smile face on the map, and that's where I like to invest. But obviously, I go into more specifics. But you look at job growth, population growth, landlord friendly. Obviously, I'm in California. It's more tenant friendly. So for me, like in Oklahoma, I can evict someone in 15 days. Like literally, I just evicted a tenant for 15 days because they're letting homeless people into their unit to take a shower. So I gave him a 15-day notice to fix it. 7 days to fix. If not, he has to vacate in 15 days. Went to court. He was evicted. 15 days. California take me 15 months. That's probably take me 15 months. So that's how I research my market. But honestly, I don't really care about the market. As if you have a good property manager, as long as the market's not like dying completely, like Oklahoma, it's a pretty steady eddy market. So as long as the market's steady, decent. But in my course, I do go over like really in detail how to pick your market, um, and why you select it. Um, dive deeper. Let me see. My first deal, sell it full seller carry. So my first deal, I got a large seller repair credit. If I knew what I taught in this class today, I probably could have got money if I raised up the price and I asked for that same raise in seller repair credit. Um, and For my second one, the guy owned it free and clear. I wanted to do subject to, but he just couldn't buy subject to for that 20 unit. So I ended up using a hard money lender, unfortunately. And then for my mobile home park, that was like seller financed. So I only down 10%, 5 year term, no, 6 year term, 5% interest only. And I deferred my payments for the first year on the interest payments. So that's the beauty about, creative financing. For home runs or singles, so to be honest, when you go off market, you find home runs. Like I'll be honest, like all three of my deals are off market. They're all going to be home runs. Like for some numbers, I got my 26 unit for half a million. It's gonna be worth 1.5 in 3 years. My 20 unit I got for 350K. It's gonna be worth 800K in about 3 years. And my mobile home park, I mean, this is my biggest gamble, but I got it for a million. It's gonna be worth, I'd say, close to 8 million once I'm done. But that's gonna take me 6 years. So basically, once this cycle of real estate's done, I'm gonna retire. I'm gonna fat fire. At that point, my mobile home park alone, like I can probably cash out refi close to like $6 million tax free over 6 years. That's $1 million tax free a year. I mean, that's like a NBA player salary, right? At that point. Um. So for Burrs, I mean, so when you go off market, a lot of the deals are value add, so you don't typically make money day one. I was lucky, like I my 26 unit, I think I made like an 8% cash on cash return day one. Plus, I can burr it. But a lot of the other deals, like you're going to be either break even or negative cash flow. But the key is you make the equity, you force the appreciation, right? So as you increase the NOI, you'll increase the property value. So for me, like I usually do pretty large rehabs. So like for my 26 unit, I'm renovating about maybe 13 units. So I can have some premium units to raise the rents from about 400 to 700, and then I'm gonna have some cheaper units at 400, which I'll probably raise to 500. And then my 20 unit, that one had a burn down unit, which is costing me so much money than I anticipated to fix. But the other ones I'm just doing a light cosmetic fixer upper. So it just really depends. Like if you're a beginner and you don't have a mentor, then just do singles and doubles. That's fine. But for me, since I underwent mentorship, and for me, I have the mindset of like I will move forward until it's successful. Like I'll make sure my deal is successful. And for me, I have a long term picture in things. So like, you know, I don't mind diving in head first to the bigger deals. But if you're a beginner, I recommend to get educated. Whether it's my course that you buy or whether you just hop on these free calls or whether you check out my YouTube channel or Bigger Pockets or whatever. But I listen to Bigger Pockets, and I don't think anyone dives as deep as me, to be honest. Um, so that needs very little rehab. So for apartment complexes, like if you don't need much rehab, there's still other ways to do value add. These are a lot of what the syndicators preach. So like you can charge, you can add a washer and dryer to each unit for like $600 if there's already hookups for washer and dryer. Then you can charge $50 extra in rent, right? So you do $50 times, whatever, 100 units. That's 5,000 times that by 12. That's your increase in NOI. You divide it by your cap rate. That's how much value you just forced. So that's one method. Another one is you can charge for like pet rent. So like, you can bring in Fido or your dog, whatever, and then you can charge like $50 in pet rent, increases your NOI. You can charge for reserved parking, increases your NOI. You can bill back the water and the trash, that increases your NOI. Um, so so yeah. I see two people dominating the comments. Any kind of questions from anyone else? Before, or I'll just continue answering these questions here. It seems like we got double eddies. Any questions? Nope. Okay. So when I'm renovating, when you do multifamily, you have to have all the renovation funds up front. Like you can't depend on like, oh, I'm gonna, depend on the cash flow to renovate the apartment complex. You need to have that money up front. Like I have $200,000 already set aside to renovate my 26 unit. And the seller, repair credit, that's just for me to have. It's nice to have an emergency fund, but you should already have the renovation up front so you're not stressed out, right? Because from my experience, renovations end up costing 25% more and take 25% longer. So you want to have that cushion. So in Austin, you can never depend on cash flow to renovate your units. You always need to have the renovation up front. Always. Um, who typically pitches initial price for off-market deals? So it's a good question. So I do. It really depends on the seller. So I do talk about some stealth negotiation tactics on my one-on-one calls, one-on-one coaching calls about how to get information without directly asking for it. So ideally, I want the owner to give me a price so they can anchor. Sometimes that price might be less than what I'm going to offer, but some owners, the two that I got, they just said I want the tax assessed price, and I immediately accepted the offer because I know that like if you buy at tax assessed price, then um, it's going to be under appraised value if you get a loan on it, right? So now moving forward, if someone says tax assessed price, I'm already going to know that I'm going to bump up the price and ask for that seller repair credit in the equal amount that I bumped up the price. So if I bump it up by 100,000, I'm going to ask for $100,000 seller repair credit. So maybe I can go into the deal with lower leverage. So that's how I kind of do it there with that. So tax assessed price. So if you look on your tax bill, it'll tell you how much your property is worth. So you can find that it's public information. So you just Google search a tax assessor's office, type in the address of your property, and then you will from there you can see what it's worth. And if they ask you, well, why are you offering me that tax assessed price? And I just say, well, it's what the state thinks it's worth. It's not. I'm not making up a number, right? Yeah, of course. I always have a max offer in my mind already. You always should. You should know what your value is. And then from there, even once I get my price, I always negotiate with inspection reports. Like negotiation never stops. To be honest, it never stops. Like I have 60 days to close the property. All 60 days, I'm negotiating things always. So my initial negotiation is getting a price, and after I got a price, I negotiate again for seller repair credit. And I usually use my inspection report to be fully transparent there. Um, so that's just kind of the approach I have. Like negotiations never end. I'll be honest. But I do go into a lot more strategies and details in terms of my course, and then maybe in later future calls. Kind of want this one to be more focused on creative financing. Um, yeah. I have time for like one more quick question, and then it's gonna end in about 5 minutes here. If not, please, if you're interested in seeing my version 2.0 of my course, it's done in beta testing. I'm probably gonna finish in about um, maybe about a month or two. But if you're interested in checking out the course, just send me an email. If you want my contacts for PropStream or Yell Letters Complete, just shoot me an email as well. If you're interested in one-on-one coaching, I do some calls depending on my availability. It's been pretty popular the past couple weeks. And if um, if you're interested in just anything, just reach out to me. I upload all these onto YouTube for people to rewatch. I went over like probably like 5 hours worth of information literally in about an hour, and I intentionally go fast because I record this and I upload it to YouTube. So please support the YouTube channel, subscribe, like, share it with your friends. A lot of my feedback has been I've been giving out a lot of free knowledge, and people feel like I should charge for these sessions, but I just been giving it out for free, to be honest. There. Um, so maybe next week, if you hop on, I'll talk about how to give full price with full seller financing. I'll probably just go through some examples next week of like live deals that I've maybe done in the past or that I've analyzed, and how I would pitch seller financing to the owner. That class is going to be way more valuable than this course or this session, but I just wanted to lay that foundation. This is a two-part series, so I do want to go over it, but um, yeah, once again, just reach out and please try to spread this. And I know I do come off hard on brokers and syndicators, but unfortunately, I've come across so many bad ones out there. I mean, there are good ones, but I just want to kind of educate everyone so you can make informed decisions, right? Because at the end of the day, brokers are made to sell you real estate. Syndicators are made to sell you deals because they make money when they buy real estate, right? They get their acquisition fee, disposition fee, asset management fee. So they're incentivized to oversell you a deal. So I just want people to have that ammo and knowledge, or at least, if you don't know, you want help, I'm certain available to help, right? Um, so in terms of mindset, it's really number one, you can't be cheap. If you're cheap, you will fail in this business. All my three apartments that I bought is because the owners are cheap, and I'm reaping the benefits of them being cheap, right? So you can't be cheap. Number two is there's always a solution to everything. And number three is always expect the unexpected, right? Like every time you buy a property, you can do all the due diligence, you can do everything correctly, you can have a mentor help you, but there's always unexpected things. But if you partner yourself with someone like me or someone knowledgeable, then they can help mitigate all those pitfalls, right? And that's the point, right? Like I said, you can learn from my 10,000 hours. I've closed on 3 deals, and I do it A through Z, right? I've done it all myself, A through Z. The syndicators, they're just like a small piece of a team, right? Like most of the people are trying to pitch you the deal, they're just a salesperson with a pretty face trying to sell you a deal, right? But they don't know A through Z. They might know like ABC, but they don't know A through Z. So, that's why, like, if you work with somebody, make sure they've done A through Z and they've done it themselves. That's how you pick who you want to work with, right? Whoever you like working with, whoever that person is, whether it's me, whether it's someone else that you met, right? It just, my saying is your vibe attracts your tribe. So I'm just myself, and I'm going to attract people that are like me. So that's why I just put it out there. Well, thank you everyone for hopping in this call. Once again, to be uploaded onto YouTube. And I hope to see everyone next week, same time, 7 p.m. Every Wednesday, unless I go on vacation. And this is uploaded onto YouTube. And please come with questions next week. I hope to see everyone next week. Thank you so much.